Good. Good afternoon, good morning, first of all, to US, and good afternoon to Zurich. I'm really happy to have here another live stream. We have today here with us Tom Jessop, President of Fidelity Digital Assets, Michael Sonnenshein, Managing Director of Grayscale Investments. You know Fred. Fred was with us in the last live streams. Then we have also Mark with us. He is an investor for more than a decade and a mentor, and also invested in the blockchain space since 2014. So good morning, good afternoon to you all. We're talking today with you about the topic that for institutional investors, what COVID-19 and so on has for effects, and what does that mean for institutional investors. So I would start with a really general question, then afterwards we would go into discussion. So first, to Michael and Tom, my question: with all the events in the year like COVID-19, the Bitcoin halving and so on, where is the crypto market going, and what does it mean for you as a company in regards to institutional investors? And I would like to start with Michael first, and then afterwards, Tom, please.
Sure. Well, so, Grayscale Investments is the world's largest digital currency asset manager. And, today with over $4 billion of assets under management, we're primarily serving institutional investors who are looking to gain exposure to crypto. I think on the heels of, for us, what was a record, stretch of inflows during 2019, bringing in over $300 million last year, we saw in Q1 over $500 million come in, and tomorrow we'll be releasing our Q2 numbers, showing even more dramatic increases in investment activity over the course of Q2. And so I think the conversation with a lot of investors these days is around that market uncertainty, a world that for them was certainly digital prior to COVID, but I think ever more looks digital and is not going to reverse course in that regard. And in the wake of central bank digital currency, conversations, in the wake of all the policy intervention we've seen and all the fiscal stimulus being pumped into the various markets around the world, I think investors are now more than ever taking crypto seriously, digging in on it, educating themselves on it, and certainly are really beginning to allocate to it, believing that it is really a bona fide asset class that they want to make sure that they have exposure to.
Thank you. Maybe just Tom.
Yeah, so we provide prime brokerage capabilities to a range of institutions that want to allocate to the asset class. So we provide secure custody, we provide agency execution, and are building capabilities on top of that stack, similar to what a traditional institution would experience in other asset classes dealing with a counterparty like Fidelity or other broker dealers. We've seen a steady increase in interest and demand on the back of the pandemic. There's certainly a little bit of that with folks that are perhaps on the more sophisticated end of the spectrum around the halvening and positioning ahead of that. But most of the uptick in business has really been a function of the macro fallout of the pandemic in the form of monetary and fiscal stimulus, where anyone that I think had a hard money thesis around these assets, particularly Bitcoin, and was thinking through the right time to implement, was catalyzed into action, as far back as the early weeks of March, and certainly ahead of the Paul Tudor Jones newsletter, which I know garnered a lot of attention. And we've seen a continuous demand and interest since then that's not really showing signs of abating. And we continue to see a broadening of interest away from folks that we would consider to be early adopters, like crypto native hedge funds and sophisticated family offices, and starting to see more interest from a broader set of clients, including, for example, a U.S. corporate that may allocate a portion of their treasury to Bitcoin. So we're starting to see people wake up, and I think there's been a lot of talk about the institutional wave. And for those of us who've worked in institutional finance for a long time know that there's really no such thing. It's more like an incoming tide that if you stand on the beach long enough, you find that the waterline comes up pretty consistently. And so we're starting to see that, and that's a positive sign, and one that was actually borne out in some research that we we commissioned with Greenwich Associates and published earlier last month around institutional attitudes towards the asset class, which we're happy to talk about if the conversation allows.
Of course, thank you for that. So I would hand over to Fred and Mark for the next point that we have. I would say we go first also to the journey of Grayscale and Fidelity into digital assets, to go then in detail afterwards in regards to the next question. So Fred, please.
Yeah, Tom, I was just wondering if you could tell us just very shortly, you actually started mining Bitcoins at Fidelity as a research project and ended up with something called Virgin Coins selling at a premium. I mean, where did all of that and how did that go into, prime brokerage? I mean, for me, that's really a funny journey.
Yeah, so Fidelity is a really unique institution. So we're a private company. We serve the needs of, tens of millions of consumers and institutions in the US and globally. And our CEO, Abby Johnson, has consistently funded basic R&D in technologies that impact our space. And so in 2014-15, the emerging technology was blockchain. And we commissioned a team of people in what is now called the Fidelity Center for Applied Technology to start doing things like running nodes of various networks. We purchased some mining rigs and started mining Bitcoin. We still mine Bitcoin today. We branched that work into exploration around private or permission blockchains and implications for traditional finance, and found ourselves, we even did interesting experiments in the cafeteria, allowing people to buy things with Bitcoin. But where that ended up was, waiting for the commercial opportunity to evolve in parallel, and probably in late 17, early 18, we felt that it was time to begin moving into the market. And we had developed a whole bunch of capabilities, right? We built wallet infrastructure. We've done a lot of things that form the, call it the early corpus of a platform. And that's how we got from experimentation to what we have today, which is an operating business.
I think you just announced another investment in a big mining company, correct?
Yeah, so that was done out of Fidelity Canada, which is a different part of the business, and they, I believe, increased their allocation in to an investment in a mining company called Hut 8, which is publicly listed in Toronto. Yeah, so it is an area of growing expertise for us, and look, our long-term vision is that this is a new medium for value in assets of all types, not only new digitally native assets, but even the application of the technology to illiquid securities and other types of private assets, which is also quite interesting on a longer term time frame.
So Michael, you're the world's largest digital asset manager. How close do you go to the value chain? Do you use Tom as a prime broker, or do you mine yourself, or are you direct Delta One hedge?
Sure. So, Tom and myself, Tom and my team, our organizations go way, way back, and we're always looking for ways to try and work together. But, I think Grayscale has is taking a little bit of a different approach to, serving investors and being a trusted partner in the ecosystem. So Grayscale dates back to late 2013. Our founder and CEO, a gentleman named Barry Silbert, I think was really early to identify Bitcoin as an asset people wanted to invest in, but recognized that it was difficult to figure out where to buy it. In that time, there was no Fidelity where you might be able to buy Bitcoin, right? People would not know how to transfer it, how to hold it, how to safekeep it. And so we thought of, he thought of an idea, which was to create investment products, right? Products that had a CUSIP, that were audited, that produced tax statements, that felt very much like the same experiences investors are used to having when they invest in really any instrument, whether it provides them access to a subset of a certain asset class or a certain commodity. And so in late 2013, we launched a long-only Bitcoin product, Grayscale Bitcoin Trust. If you fast forward to today, again, with over $4 billion of assets now, we have a whole family of 10 investment products. And so really for us, our mission is to open up access and provide exposure to investors, really giving them the tools they need to be able to allocate to crypto. And to date, all of our investment products either facilitate exposure to one single digital currency, or in the case of our digital large cap fund, a basket of currencies. And I think for investors, the world around them is changing really rapidly. You have to think about the fact that it has become orders of magnitude easier to buy crypto, which is fantastic, and still allows investors to be able to participate in a variety of ways, whether it's with Grayscale or Fidelity or some of the other great service providers coming up in the world. But I still think that we're in the very early innings of this. And to Tom's point about standing on the beach and having the tide come in, I think the world could not have written a better script or created a better backdrop for why digital currencies have a place not only in the world, but also in investors' portfolios.
So I guess you both actually mentioned something about, let's say, the trust cycle, right? So one is basically the investment part and as a vehicle, and the other one in prime brokerage. But what does real market integrity look like?
Yeah, maybe I'll take a stab at that, and then Michael can jump in. Yeah, look, I think one of the challenges that we still see is the evolution of the market structure. And a simple example, right? If you're an institution and you want a best price experience buying crypto directly, it's changing, but you would typically have to leave open accounts at various exchanges and leave cash or Bitcoin on exchange for purposes of affecting transactions. That's not how the rest of the financial markets work. So what we've done is we've brought the markets to our clients where they have something resembling a best ex experience. We aggregate liquidity and we act as the settlement intermediary. There are other people now doing this, but in the early days of crypto, that was a practical challenge for traditional investors coming into the market. So that's changing. I think, the other thing, there's a perception that there's still manipulation going on in crypto markets. I think to some degree that is a vestige of the same argument that was been used in the past about, only criminals use Bitcoin, which again, based on the data, that's been, disproven. There are far more bad people using cash to do bad things than digital assets. But suffice it to say, there are people, what Michael's doing, what we're doing, and other people really trying to pull this asset class into the mainstream. And, the numbers of us are legion trying to do this. And I think over time, some of those concerns will be addressed. And I think the most important concern to some degree is just available liquidity. And I think what we've seen, recently and steadily is that liquidity is improving in the market. It's still somewhat fragmented, obviously globally. Market infrastructure can change that. But I think when you're a large investor and you're thinking about putting money to work, that's clearly a concern you're going to have, which is, if I want to put on a few $100 million of exposure, what are we going to do here to the market? And again, there are a lot of people looking to fix that, and I think it will be fixed.
Yeah, I think Tom brings up an interesting point, which I think from an investor perspective, it's really, really important that people know who they're dealing with, whether it is Fidelity, whether it is Grayscale, whether it is some of the other credible players in the space that are taking a compliant approach to providing access and exposure to crypto. I think, one of the things and some of the signals that my team is certainly focused on is the emergence of a lot of this market infrastructure that, we take as validation of the asset class, and we think has really been a propellant of getting more investors into the ecosystem. And so today we're seeing companies developing, best-in-class order management systems. We're seeing companies developing, regulated benchmarks and trying to create a more global order book, which, today still does not exist. It's still quite fragmented. We've really seen over the last, call it 12 to 18 months, really the development of a much more robust lending and borrowing market, really seeing deep pools of liquidity moving into derivatives, futures contracts. And, in the absence of a lot of these tools, if you want to call each of those aspects a tool, you would not see the level of investor participation that we have today. And so I think, folks should be really, really keyed into how each of those elements are developing, because you have to remember that as an asset class, Bitcoin, crypto in general, was not around, 10, 12 years ago. And so to see some of these, futures contracts and the regulatory clarity that we now have around the asset class, there really aren't that many excuses left for investors to ignore crypto or not at least consider it. So we would kind of say it's certainly not going to be something that's for everyone, but it certainly is something that everyone needs to be considering seriously.
It's definitely for more and more. I mean, one of the great things CfC has done over the years is really bringing experts from all kind of different areas together. Michael, Tom, you mentioned a lot of the advantages of that institutional investors need now and have access to. I would assume that some of our participants know what a prime broker is in the traditional world. What are the services they are missing in the crypto side today, and where would they go?
Yeah, so from a prime services side, I think there's probably 3 or 4 major services. One is obviously in digital assets is the custodian, so the safekeeping of these digital bearer instruments. The second level is what I would call the on-ramp to the market, or the agency execution, someone that's going to bring the market to you and disambiguate some of the complexity of the crypto market structure. Third level would be around, as Michael said, lending facilities, right? Being able to utilize your assets in different ways, perhaps than you could if you were not engaged with a prime broker. And there's obviously other services that emerge, more sophisticated trading capabilities. At some point, my guess is that investors will want to see transaction cost benchmarking, and they're going to want more sophisticated types of executing, guaranteed price at close of day, or VWAP. And so those are all the things that, again, exist in other asset classes. We're not reinventing the wheel here, but we're trying to bring to this asset class, right? Because that's the form factor that traditional institutions are most comfortable with.
I think you've seen like Coinbase making some steps in that range, but I think it's the institutional experience that, for example, companies like Fidelity bring will help traditional investors to understand much better what's possible here.
When we look at the value chain, it's still a little bit different, right, than traditional custody for bonds or debt products or stuff like that. So I guess, Michael, I mean, if I would buy one of your funds products or guide some of my institutional investors or some of the banks I service, the main question will always be, who has control over the keys and how are this being audited? So I guess my question to you would be, one thing is that I'm buying a fund product, but in the aspect of security and the trust cycle, do you actually hold the keys?
It's a great question. So all of the assets underpinning the Grayscale family of products are held with Coinbase custody, their institutional platform. And so all of the assets sit on segregated addresses that belong to each of the investment products. There are caps on the amount of coin that can sit on any one address. And those familiar with the Coinbase custody solution, there are many people involved in the ability to access the crypto, combining people from Coinbase and certainly people throughout my company as well. And so it is definitely a multi-signature approach to keeping assets in cold storage, not to mention that they also carry an insurance policy. And so I think for our investors' benefit, similar to what Tom was talking about in the prime brokerage space, as an asset manager, we're not trying to reinvent the wheel either. We're trying to take our cues from incumbent asset managers, try and find the best custodian, the best transfer agent, the best reference rate, the highest level of disclosure, highest, best auditing firm, et cetera. And so all of the Grayscale products are in fact audited annually. In fact, our flagship product, the Grayscale Bitcoin Trust, earlier this year became an SEC reporting company. So we actually now file 10Ks and 10Qs and 8Ks. And so from an investor perspective, they now enjoy the same protections and disclosure that they would see for any publicly traded instrument they would be investing in on a national securities exchange. So I think it's for us really trying to push ourselves to hold ourselves as a firm on behalf of our clients in a fiduciary capacity to the highest standards possible, and to give investors the assurances that they need to be comfortable using these instruments.
Maybe just picking up, Michael's description of how custody works was perfect. I would just add, coming back to the audit comment, I think what's interesting is when you think about evidence of ownership in other asset classes, it really is traditional ledger, traditional accounting, right? There's a ledger entry that says Tom owns this asset. And the way to think about it in the custody world is, there is, as a custodian, we maintain books and records that show what our clients own, and we reconcile that against our wallet addresses on a regular basis. And all of that is audited in our case, and I think with other custodians by a Big Four accounting firm, where we have SOC 1 Type 2 audits issued for both our custody and execution services platform, which is not only validation of the underlying policies and procedures that we've constructed, but do they work as advertised? So it is called an audit in motion, right? It's not only do these policies and procedures work, are they fulsome, but in practice, are they being applied? And that gives investors comfort that when we say to them, you have 100 Bitcoin in your account, that in fact, those things exist because of these policies and procedures and reconciliation. So I think sometimes people tend to look at this and say, well, gee, like that's not good enough, but it's actually good enough in every other asset class. We provide this other layer of validation around the actual auditing of the procedures that allow us to link the wallets to the books and records.
What's funny about that too, Tom, is that, unlike a traditional asset where you may have a bar of gold or whatever it may be, and it's sitting in some vault somewhere, and you're relying on someone to physically go down there and count the assets. With crypto, with assets like Bitcoin, any connected device anywhere can in fact validate that you have what you say that you have. And investors take a lot of comfort in that. So, I think while some people struggle initially with how to actually ensure that assets in the crypto space are in fact held at the places and in the quantities that they say they are, they have this, whole other system independent of that they themselves can look at as well. So it's an added benefit, to say the least.
Transparency is really important. And I think most people underestimate how much effort it takes to stay compliant. And even as an investor, as a small, medium-sized investor, but even as an institution, we want to make sure we are compliant with local regulations. We pay our taxes. We don't want to get in trouble with the IRS. Absolutely not. So we're doing really everything to making sure we are doing things right. And as you said, Michael, the transparency that blockchain assets provide can be an opportunity here, I think, but making it, so how do you drive that transparency from the blockchain into auditable records for your investors and the institutions? How do you work with them on a day-to-day basis to making sure they are showing how compliant they are?
Sure. So I think for us, certainly the actual audits themselves that are done by third parties certainly help investors taking a look at that. And so we work with auditors to demonstrate control over addresses, right? Having a custodian that has those SOC certifications that Tom mentioned. And then of course, having a wholesome DDQ, a due diligence questionnaire, right? So it's very typical in the institutional realm for investors to do their diligence on you in every aspect, operations of the business, employees, really any and all procedures. And the fact that we are now also operating an SEC reporting company, we now also have Sarbanes-Oxley internal controls to make sure that we're also complying with as well. And so from, an investor standpoint, there's really not much more that we could be doing to demonstrate transparency in compliance with any and all of the applicable rules that go into running our products.
So what do you see? I mean, when we speak about institutional investors, I mean, that can be anything from a BVI company who has an anti-money laundering license to being JP Morgan or a pension fund. So I think both of you said, you see the market opportunity, you see the cash coming in, you're primarily targeting institutional investors. But could you tell us a little bit about what is an institutional investor when you say that? Because I think there's different buckets and there's different needs and there's different requirements from a regulatory and from a trust perspective and infrastructure perspective.
It's a good question. I mean, I think I define it as, call it a obviously no natural persons. And in many cases, folks that have some fiduciary obligation to an investor or constituent. So that really takes you from everything from a single family office to multifamily office to registered investment advisor to hedge fund, and all the way up through the very traditional definition of institution. And those are the clients that we serve. And what I would say is, coming back to this idea of the tide or the progression, the typical process is first people have to be educated about the asset class. Like they have to understand, particularly if they're acting in a fiduciary capacity, what is the positive impact of adding this asset to my portfolio. So it really is education and understanding what is my thesis, right? So you have traditional institutions that perhaps think about this in the alt sleeve, right? It's idiosyncratic, it's different, it's not part of the core portfolio, and that's where they apply it. Increasing number of people are looking at the adding Bitcoin to a traditional portfolio for purposes of improving Sharpe ratio or the the diversification benefits of an uncorrelated asset. And that just getting to the point where they have a view on what sleeve does it sit in, does the math work, do I want to do this? That's sort of phase one, is the thesis development, right? And then there's the operational diligence. Michael talked about it in the context of, onboarding, the clients doing diligence on us or, Michael's funds. But it's also thinking through how they can operationalize the exposure. And that is another block of work. And then and only then do they get to the point where they are ready to take action or allocate. And depending on where you sit on that spectrum of investors, clearly a single family office has much more latitude to compress all of that work and allocate. A pension or an endowment, that is very, very extended, that time frame. And particularly when you get around some of the operational diligence issues that involves consultants and others. The good news for us is we're seeing everyone kind of moving through that time frame and pipeline with increasing frequency, right? The folks you'd expect are further along are perhaps the investors that typically have and could take more risk, and the ones that are just starting their journey tend to look like the more traditional investors. That's effectively how we define the space and kind of where we see people moving through the, for lack of a better term, the journey, right?
Yeah, Tom, I think we're seeing a pretty much identical to what you've said as well. Institutions for us are professional investors, not natural persons, managing capital on behalf of other folks. Most certainly correct. The family office, the hedge fund are going to be much faster to execute on the idea than a pension or an endowment where there's many more layers of approval, or they just generally as an organization move slower or a lot more methodical. I think one of the things that's been most validating to us at Grayscale, though, is the hedge fund segment of institutions that have been leveraging our products. I think that there has long been this notion that Bitcoin and digital currencies are these really high octane trades, and it's really only for people that invest in tech or are really momentum investors. And when we actually take a look and break down the investment strategy of the different kinds of funds deploying capital with us, it really goes across the entire spectrum. So we do have certainly momentum folks and tech folks, but we have no shortage of multi-strat funds, value funds, risk arb funds, global macro funds. And I think what's important to note about that is for us to do our job in educating folks that crypto is not for any one segment or any one type of investor. That depending on where you're comfortable investing, what you historically have invested in, you more likely than not will find some area that you do have exposure to today that crypto or the advent of blockchain technology stands to have a meaningful impact on it. And so whether investors are excited about allocating because of the technology, it's affecting payments or other areas that they're invested in, certainly the digital gold narrative, folks thinking about investing in crypto as a digital inflation hedge or just a digital investment in a world that's gone digital, or ultimately thinking about crypto and other assets, as Tom said, as a way to diversify. Investors are constantly seeking this holy grail of uncorrelated alpha, and in a world that very quickly has shown itself, like we saw in March, just this massive deleveraging, everything kind of converging at once. It's really taken a lot of investors, very little time to see how fast crypto rebounded compared to a lot of other asset classes. And again, showing the resilience of it. And again, something that they can invest in over the medium to long term.
You both mentioned the whole life cycle of financial asset management here. And I think would like to drill down a little bit more about how the sausage is actually made and looking at the infrastructure itself. So what does it take to actually make this happen?
So in terms of giving investors the comfort they need to actually execute?
I think so, yes. But
So I think, our approaches are similar, but going to be a little bit different. So I'll say at Grayscale, I think what investors are looking for is certainly one, custodianship comes up. So we have the conversation around who we're using, how we can prove the assets are what they say they are. I think number two, it's disclosure. So having robust offering memorandums that outline risk factors and what the reporting obligations are going to be of the fund. I think three, it's about valuation. And so walking investors through how we fairly and transparently value the fund and the assets in it on a daily basis. And then I think four is process and procedure. So how it is that we go through KYC, AML, have investors fill out documentation, how funding goes, and ultimately how investors actually have an investment done. And that usually gets them through all the questions they have. And people generally are comfortable with it, especially given the track record and the operational track record of success I think that we have.
Yeah, so I'd love to jump in here and give a little bit like a cliffhanger to Tom, right? Because when I look at it right now with my compliance angle representing a big four company, right? Some of our clients really has a big issue in buying digital assets because you can actually, they have a history which is a lot deeper than a traditional asset, huh? And so how do you actually validate that the Bitcoins or the Ether you're buying are not just clean, but like really clean?
Yeah, great question. So this is, I think, a lot of people that aren't particularly deep in crypto find this kind of fascinating, but as I think, Fred, what you're alluding to are these forensic tools that allow you to look at blockchain or Bitcoin or any type of transaction and do forensic analysis of the origin or the path that those assets have traveled before they come to you. And there are tools out there that allow you to do that. And what we do and others do is we apply a set of rules looking at these tools to say if some number of transactions back in the life cycle of this particular asset, it touched a known bad address or an address that has been identified as, call it suspicious by the tool providers, the compliance tool providers, we reserve the right not to accept those assets. Now, what's interesting is as you get more velocity on the Bitcoin network, over time, I think you work your way out of that problem, right? Because the incidence, as the network grows, assuming that the network of bad actors is also not growing at the same rate, which I don't think it is, that problem becomes less and less of an issue because you have to go further and further and further and further back before you find a hit with, an OFAC listed address or a bad address. So again, I think, look, and you can apply the same lens to fiat currency, right? I don't know what the number is and I won't quote a percentage, but people say that there's drug residue on some percentage of dollar bills circulating in the United States. Like at some point, it's been used by a bad person. What's unique about the Bitcoin network or any blockchain-based asset is you can forensically go back and determine, did this ever touch a bad entity? And you can maintain some degree of cleanliness, let's call it, around that process.
I guess so. Where I'm going a little bit with this is obviously, this is really interesting, right? Because in the start, I think Michael said, we're doing everything from a regulatory part we can do, and we have regulatory clarity, right? But I think there exactly is where the regulatory clarity stops, right? Because we actually don't have any precedents on how many layers we need to go back. We just know that, the more institutional you are, the more is expected from you that you actually think through those change, right? And you think through, how do I put in, procedures and processes around that in something which hasn't gone to court yet.
Yeah, and look, and that's something that to some degree is market driven. It's also driven by the type of service we want to provide to our customers, where we will set those parameters consistent with how we want to run our business, right? Some people may may not use those tools. Some people may use those tools to a significant extent, but I think at some level it's up to the industry to determine best practices and compete on who can provide a better, more compliant service that meets the needs of investors. Classic example is when you think about confirmations on a blockchain, right? The industry sort of settled on a blockchain transaction is not, call it complete until 6 or 7 confirms, right? That's kind of an industry standard. That's where the industry said, knowing what we know about the technology, that seems like an acceptable number of confirms to say to a client, okay, the transfer has been completed. So I think, there's some things that the industry needs to do to kind of enforce those best practices in line with what their clients want. And then obviously there's a regulatory overlay that we certainly are compliant with and want to be, because that's effectively the level of the service that we want to offer to our clients, right? It's all about safety and solidity and compliance. That's how you win institutions.
As an investor, I would love to go back to a little bit more what Michael said earlier for the wild ride of the last 5-6 months we had in the markets, and possibly where do we go from here? Is the decoupling between crypto assets and the S&P, is it going to happen? As an investor, how should I think about my different asset allocations across all the different instruments?
Sure. I mean, I think most investors, and I want to be clear about the subset of investors we're servicing at Grayscale, because of the nature of our products, we're servicing really only folks that have a medium to longer term time outlook for their crypto allocation. So the folks that want to invest in Bitcoin, want to see it have a 10-20% move and take their money off the table. That's not the folks that we're typically looking to engage with. And so I think what we've seen now is quarter after quarter empirical data of when asset prices in the crypto space, take a dip. We're actually seeing that as an opportunity that our investors are tactically using to add to their allocations. I can never remember a day where we were getting phone calls or emails from investors when crypto is, having a bloodbath of a day, down 20, 30% or whatever it may be, saying I need to get my money out of this, or I wish I hadn't invested. Instead, I think, the folks that have really dug in and spent the time on the asset class believe in the direction that it's ultimately going. And so again, are going to use that to add to a position. I think some of the things that have come up in conversation over the last 5 to 6 months, though, certainly one is the Bitcoin halving, right? We've seen now 3 halvings in the Bitcoin protocol, and historically seen that be a price catalyst in the weeks and months that followed. By and large, Bitcoin has been relatively range bound over the last couple of months, kind of in this $8,000 to $10,000 range. And also, if you look back at time around that as well, those periods where you see Bitcoin have lower volatility like that tend to predate pretty dramatic movements in price, positively or negatively. And so I certainly am not going to, pretend to be any kind of an oracle and, predict where the crypto market is going. But what I can pay attention to and what I can share anecdotally, which I think Tom will agree with as well, is that the types of investors showing up to the asset class, the size of the checks they're writing, the reasons why they're allocating, these are all really, really important considerations that for me make me continue to have the conviction that I do, that again, it's early days and the overall outlook for where this asset class can go is pretty staggering. But folks need to be patient with it. Remind themselves we've come a very, very long way in a very short period of time.
So obviously, I have to ask the question now, right? So, looking at your prime brokerage, Tom, and looking at your investment appetite, Michael, right? You are very much centered around Bitcoin and maybe a very few altcoins. So, what's happening out there? Don't you see any other, interesting thing, or is it due to regulatory part? Is it investor appetite? Why are you so centered on, let's say less than 5 assets or 5 coins?
Yeah, maybe I'll go first. Look, so we're very client driven, and as I mentioned at the start of the hour, we completed a survey of about 800 institutions globally. Actually, that survey closed probably a week before the lockdown. And what's clear is that for traditional institutions, Bitcoin is sort of the gateway digital asset, right? It's the one that has the longest track record. It's the one that's spoken most about in the press and in the academic literature. It has characteristics that most traditional institutions can understand in terms of impact on portfolio. I think once you go further down the list of assets, I think there's a question mark about the viability of some of these projects, or perhaps just the timing of when they will become viable. So for the time being, we're very focused on really in market cap order, which objectively makes sense. I think the other thing we're watching very carefully is the application of the technology to traditional assets. There's been a lot of talk about issuing private securities, illiquid assets on blockchains. We're starting to see more of that. There are a lot of large financial institutions that seem to be trying to move out of the proof of concept phase and into something that can be implemented. I would say that to date, a lot of the activity has been quite spotty, more proof of concept. But we do see consistent interest in figuring out ways to leverage the technology to make existing capital markets more efficient, again, particularly on illiquid securities. And that's an area, just given Fidelity's pedigree and the sort of clients that we deal with, that we're keeping close eye on in terms of being able to help support some of that activity.
Yeah, I think for us at Grayscale now, so we have 10 different investment products. And thinking about the 10 products we have, we're actually providing exposure to, within that product family, 9 different digital currencies or 9 different protocols. There is zero question that for the vast majority of investors, their first foray, their first allocation typically is into Bitcoin, because it is more often than not where they've spent the most time in terms of doing their own research and getting comfort with it. There's tons of great educational tools for them about Bitcoin. And not to mention, Bitcoin has overcome a tremendous amount of adversity over the past 10, 12 years that I think gives them a lot of comfort in its longer term prospects. I think that being said, we have seen over the past few quarters growing pretty rapidly investors seeking out diversification within the asset class beyond just Bitcoin. So we've seen a lot of pickup in the Grayscale Ethereum product, the Grayscale Ethereum Trust. We've seen similar things in our Bitcoin Cash Trust, our Litecoin Trust. And then we've also seen really the emergence of investors who want to just allocate to the asset class as opposed to picking a single digital currency. Maybe they feel that they missed Bitcoin or they missed Ethereum. And so we've seen a lot of interest in the Grayscale Digital Large Cap Fund, which is a basket of large cap digital currencies inside of a single investment product. And I think now I have to say, I have to look at our numbers, but I believe over half of our investor base has allocated to more than one product, meaning that over half of our investor base has allocated to more than one cryptocurrency. And so I'm of the belief that over time, investors are not only enjoying the benefits that crypto exposure provides their portfolios, but also seeing even further diversification benefits of having exposure to more than one digital asset as well.
Okay, I mean, that really makes sense. But I guess what I'm aiming at here is I feel that there's a huge lack of quality research, ratings, and reference rates out there. I mean, one of the jobs I get a lot is, what reference rate can we use on certain asset classes for a bank or for an asset manager when we're looking at Bitcoin or Ethereum, which is definitely not something we're having on, let's say, a traditional asset class. There is very clear rules about, what are the rates and what are not the rates.
Sure. I mean, I know for my team, in terms of reference rates, we've historically and currently still work with a provider called TradeBlock that's developed a whole series of indices that allow us to verifiably create a spot price, looking at some of the largest dollar-denominated and compliant exchanges for a given asset, and then in real time see them algorithmically weight each of those constituent exchanges to create a composite price. And that for us, following IOSCO principles and a lot of the other constituent qualities that investors wanted to see, has definitely resonated with them. And then I think on the research side, there's, I'm going to disagree with you respectfully. There's actually quite a bit of good research. The Fidelity digital assets team writes great research on the space. My team, a gentleman named Phil, writes some fantastic pieces on the ecosystem. In fact, CoinDesk recently just opened up a research hub where they're aggregating digital currency research from a lot of different folks that are publishing on the space. And so I think there's probably, to your point, maybe no shortage of research, and maybe it takes people a little bit of time to find those who are writing maybe a little bit more quality research or geared towards what they want. I think certainly at Grayscale, and I think for Fidelity as well, and Tom can jump in, but I think we're trying to write about digital currency in a way that allows investors to think about digital currency in the context of the other assets they also own, and looking at things like portfolio construction.
We'll make sure we put all of those links into the show notes, I think, right, Nicolo?
Yeah, I agree with Michael. I mean, I think that for maybe where there's the disconnect, there's a lot of great research, and it came up in our study of institutions, right? The third, if you think about the reasons why they may be reluctant to allocate, right? High on the list, number 3 was lack of fundamentals. And when I actually thought about that, it's a bit perplexing because the blockchain is a public network. There's a huge amount of fundamental data. You've got people that are looking at known whale wallet addresses to see if there are movements in or out as a precondition for perhaps market movement. So there's a ton of data out there that folks that's available for free that they can analyze in real time. So I think that where the disconnect might be is you're taking this lens that you use to value other types of assets and trying to apply it to this new asset class. So on one hand, you have all of this data, but people say there are lack of fundamentals. And to Michael's point, what we're trying to do and what he's trying to do is begin to develop a body of work that says, this is how you have to think about various models for valuing these assets. And that looks different than how you would value a stock or fixed income instrument. And I think that's super important in terms of bringing institutions in. We have to give them the roadmap. And there are a lot of good people doing this. And I think the work that CoinDesk is doing with this research hub is great. And it's a big part of our value proposition is some of this research. And it's not only research about the asset and the role in a portfolio, but we wrote a piece that said, this is how digital asset custody is different than traditional custody, right? Because if you come from a traditional mindset, you kind of don't understand. So even at that level, we write research about the fundamental underpinnings of the infrastructure in the market, because that's something we need to do to get institutions more comfortable with the asset class.
I mean, you at Fidelity have probably a broader insight in asset allocation of your customers globally. I mean, I can only see it anecdotally. A lot of the traditional investors are sitting on cash right now. So they're really trying to look, as Michael said, for the alpha in a as safe as possible way. Why still is the move not that strong into the crypto asset for the most of the traditional side? What's in the way?
Yeah, look, I think it's all your perspective. And I think if we're using the last few months of 17 as a benchmark for people moving into crypto, I mean, I don't know if we'll ever see that again. That was a retail driven blow off top or whatever terminology you want to attach to it. I think that on the institutional side, it's what we talked about. It's the fact that look at ETFs. ETFs were invented in 1993, right? 27 years later, I mean, they're now front and center as far as traditional allocators, et cetera. But that took a really long time. And so, it's education, it's getting them comfortable with the infrastructure, ways to value the assets, thinking about them in portfolios. To Fred's earlier point, it's research, it's, what is the end of day mark and does that reflect an accurate market value for these assets? So I see it happening. I think, Michael sees it happening, and anyone who observes what Michael's business is doing sees it happening because the numbers have been tremendous. So it's like steady as she goes, up and to the right.
Yeah, people need to just be patient, honestly. I think that's the thing that we find most frustrating being on the inside, if you will, of the crypto space. There's this impatience that if you can't buy a cup of coffee with Bitcoin yet, that somehow Bitcoin hasn't succeeded or hasn't fulfilled its value proposition. And again, the signs and signals that we're paying attention to continue to give us a conviction that it is all in fact happening. But I know certainly for my team, buying a cup of coffee with Bitcoin is for us not the measure of success. It's, to some of the things Tom was talking about, network fundamentals, wallet growth, activity, these are some of the things that, we can verifiably point to when you want to kind of give any one of these networks a checkup, if you will, take it to the doctor's office and see how its health is. Those are some of the things to be paying attention to.
So another thing outside Michael's business, which is booming, is definitely the dollar-denominated stable coins, but also some other, let's say, stable coins. So what are you seeing here? Without mentioning any specific names.
Michael, you want me to go first?
Sure.
Yeah, it's an interesting phenomenon. I mean, it's been a real growth area in crypto, certainly this year. So what the market cap of stablecoins is about $12 billion. I think about 80%, if not more, is Tether. So I guess the question is, if the broader market was in a risk-off mode, does the increase in stablecoin activity reflect a risk-off mentality among traditional crypto traders who are moving in and out of Tether, as an example? I think there's this view that there's an opportunity around better payments infrastructure using stablecoins, or folks that don't have access to fiat currency or call it get access to dollars can access them more easily. Stablecoins, I think all of those things are true, but I'm not sure that's actually what's driving the growth right now. I think it's probably just more of the same. Having said that, it's a fascinating space to watch, not only with what's going on today, but what Libra's doing, some of the central bank activity. So I do think that'll be a fixture of the market going forward. And it brings me back to the first time I bought Bitcoin, and I said, wow, it's this purely native digital money. This is so cool. And it's like I'm scratching my head, but I still have to link a bank account and wait several days. And it's like you need that stable value on these networks to facilitate all types of settlement. And I think if we can do that, then I think the opportunity just expands dramatically for this technology to underlie all types of value and asset transfer. So it's not going away.
Yeah, I think Tom hit on probably the most fundamental and most frequent use case around the rise of stable coins, which is really about infrastructure and folks wanting to be able to move in and out of crypto faster than the traditional financial system would allow them, right? If you're selling something and you need to settle into US dollars and get to cash or rely on any kind of intermediary system, using stable coins and a lot of these protocols can actually speed up a lot of those transactions and certainly be an aid to people that are a little bit more active in the space. I think though, over the past year or so, a lot of the conversation around this has been significantly impacted by the Libra project and thinking about a major behemoth global company like Facebook having their ties to a stable coin. And I think that's caused the investment community to get a lot more focused on this. It certainly got regulators to be a lot more focused on the asset class, and also caused a lot of sovereign states to really propel forward their central bank digital currency plans as well. We recently authored a piece about this, and I think it's really important for people to understand and not conflate the two, which is looking at stable coins or central bank digital currencies, making sure that they understand that these, in fact, as they're proposed, as they're intended, they do not exhibit the same qualities or attributes that a decentralized protocol like Bitcoin or others have. And so from our perspective, while we don't know how the central bank digital currency thesis is going to play out, we don't ultimately know what Libra, or now I think it's called Nubi, is going to play out. What we are encouraged by is the fact that a lot of conversations around regulation and regulatory clarity and really focusing on crypto assets in general, those conversations, as a result of how much this has taken center stage, have been moved up dramatically on the timeline. And so we've seen a lot more intense focus, for better and for worse, on the asset class, and definitely something for people to keep paying attention to.
Yeah, so just from my side, I see that I brought together 4 people that can discuss. I think we could discuss for 2 or 3 more hours, just keeping the time in mind. So I would give Mark and Fred one more question, and then I would say we close the discussion, because I think we could really go on for several hours afterwards. Fred has a lot of questions. So yeah, I would just ask Mark first and then Fred to close it. Just the last question from your side, Mark.
Nicola, you're absolutely right. There's so many questions, but just picking up on something Michael just mentioned, on one side, we have decentralized cryptocurrencies. On the other hand, we have governments driving central digital currencies. We have the Chinese with the blockchain service network trying very aggressively to play a role here. How important for you and for your investors is geography, policy regulation?
I think it's huge. I think, in addition to education, which Tom mentioned is probably one of the biggest gating items for investors, ever more regulatory clarity is something that investors too are looking for. I think here in the US, we've seen quite a fair bit of regulatory clarity from the SEC, the CFTC, the IRS, FinCEN. We've seen, licensing programs rolled out. I think in other areas of the world, we've seen some really favorable policies been enacted, and we've also seen some folks that have taken more of a wait and see approach. And so I think the more of that we see globally, certainly should be a tailwind to more investor participation, no doubt about it.
And I would just add, I think, obviously regulatory evolution is important. We have this novel new technology, but we, at least in the US and perhaps other parts of the world, we have regulations that were constructed in a time when, financial technology was a telephone and a ticker tape machine. And so we need to modernize. I also think the policy aspect is important. And I think one way to get regulatory progress is, certainly in the US, has been done in other jurisdictions, is really focus on the longer term policy implications of this technology, not only in our hands, but in the hands of folks that may not have our best interests at heart. And I think, you're starting to see that picture evolve overseas. And I think it's something that we probably need to elevate a little bit. And if we do that, I think some of the regulatory implications will come maybe to the fore in a bit of a faster time frame.
Thank you very much, both of you.
Fred, your turn now to close this discussion.
Yeah, so I guess I'm just looking for like a bullet point from each of you, right? So my question would be something like this. What is the #1 killer feature central bank issued digital currency should have, in your view, to create a real difference?
Peer-to-peer transactions, how's that?
How much? Sorry?
Peer-to-peer
Transactions.
Instantaneous. Yeah. I can just send you dollars immediately.
Yeah. I think for me, it'd probably be something, that's definitely one that would be great. I think another one would be to try and eliminate or have built into it the inability to, manipulate or have, rates be subject to policymakers or printing and retracting. And so a little bit more definition around supplies and rates, things that probably more closely resemble the kinds of things we see in decentralized protocols. That's probably a far-reaching hope, but nonetheless, one that I think would give a lot of protections to folks who end up using these, who have historically had their purchasing power eroded sitting in fiat currencies.
Okay, so one last question from participants who watched the whole stream. Which approximately 2 billion locked or pledged in DeFi projects do we think that it's important growing trend? It's an important growing trend, yes or no? Did you understand the question?
No. I think it's important. I think the question about DeFi for me is, if you have all of these decentralized protocols, it would follow that you need a parallel financial system to finance and basically bring those protocols to life. And so the question I have is DeFi, call it the capital market or financial infrastructure for decentralized protocols exclusively, or will it have implications for traditional finance? And I think it tends to be more the former. Mm-hmm. So I think it's positive that you're seeing this parallel financial universe develop around some of these protocols, which should continue to support evolution of decentralized applications. But I tend to think of it very differently than I think about the world of traditional finance, which I think the two will remain fairly separate for some period of time, if not forever.
Yeah, I wouldn't even add anything to that. I think that's exactly right. I think it's definitely something that people are paying attention to, and trying to see how the capital formation process and all kinds of other investor-focused events may happen going forward using DeFi, I think is something that is only going to probably gain momentum.
I'm also very positive on that. The only thing I would say is that Bitcoin got it right, more or less from the first issuance. DeFi didn't, but the scope of DeFi is probably going to get a lot bigger than Bitcoin ever was, and it's going to change the world as we know it in terms of capital formation, allocation, metadata, and distribution. Yeah, I'm a big fan of MakerDAO, for example, for a long time, and Rona and his team doing a great job. So I think that's really building an alternative system that will provide access to the financial instruments, even like things like insurance, to people that do not have access today on a global scale. I think there's huge potential for that. But Nicola, as you said, it's 2 billion. It sounds like a great number, but Grayscale has 4 billion under management. So there's definitely a lot of room to grow.
Perfect. Good. Then thank you very much to all of you. Tom and Michael, thank you very much for for being here with us in this conversation. It's a small example of how the CfC works. I mean, Michael, you know it, or except Tom, everyone knows it, how that works. So it was really, really nice. Thank you very much for this discussion. I enjoyed it really much. And then I wish you a nice day, a good day in the US, and Fred, a nice evening, and we see you soon. Thank you very much for your time.
Thank you.
Thanks, everybody.